For the first, the business nature of 7-Eleven and Mr.Diy. 7-Eleven is a 24 hours convenience store selling snacks, drinks, and daily items. It's easy to find near LRT station or busy areas, perfect for urgent needs. Mr.Diy sells affordable home and lifestyle products like tools, kitchenware, and stationery. Their stores are usually in mall and focus on low price and variety. In short, 7-Eleven offers speed and convenience, while Mr.Diy offers value and choices.
Good day, madam. My name is Lim Shen Yang. In 2023, the company showed strong liquidity with the current ratio rising to 1.16 and the quick ratio to 0.84. However, both declined in 2024, suggesting tighter short-term financial health. The debt ratio dropped significantly in 2023 to 0.31, then increased again to 0.x6 in 2024, indicating higher leverage. The time interest earned ratio improved sharply in 2024, reaching 70.30, showing strong ability to meet interest payment. On the efficiency side, both inventory turnover and fixed asset turnover have declined over the years, which may point to less effective use of resources. Profitability remains strong in terms of gross profit margin, stay above 30% in 2023 and 2024. However, net profit margin and return on equity saw a drop in 2024, signaling a decline in overall profitability and return to shareholder.
My name is Tan Hui Chin. Today I will present the financial ratio analysis of Mr.Diy from 2022 to 2024. For liquidity ratios, the current ratios and quick ratios increased steadily, meaning better short-term debt payment. The average collection period dropped to 9 days in 2023, then increased to 12 days in 2024. Account receivable turnover was highest in 2023. Inventory turnover also improved. For capital structure ratios, the debt ratios decreased over the 3 years, showing less use of borrowed money. Time interest earned dropped a bit, but the companies could still pay interest easily. Under asset management efficiency ratios, total asset turnover stays stable, while fixed asset turnover dropped in 2023 and rose in 2024. In profitability ratios, gross profit margin improved each year. Operating and net profit margins decreased in 2024 but remain strong. Operating return on assets stay high and return on equity decreased, meaning shareholders earn less. In conclusion, the company should focus more on asset uses and shareholders' returns.
Next here is comparison between 7-Eleven and Mr.Diy from 2022 to 2024. Mr.Diy current ratio rose to 2.3x, 7-Eleven fell to 0.88. Quick ratios, Mr.Diy 0.68, higher than 7-Eleven 0.66. Collections, Mr.Diy's 12 days, 7-Eleven 29 days. Receivable turnover, Mr.Diy 31, 7-Eleven only 12. Inventory, Mr.Diy up to 2.33, 7-Eleven down to 1.92. Overall, Mr.Diy wins in all liquidity areas. Next, from debt ratios, Mr.Diy down to 0.49, 7-Eleven up to 0.86. Interest cover, Mr.Diy stables, 10 plus 7-Eleven travels to 1.42. Asset turnover, Mr.Diy 1.22, higher than 7-Eleven 1.19. Fixed assets, Mr.Diy 5.28, 7-Eleven fell to 5.15. Overall, Mr.Diy is more stable and efficient. For profitability ratios, its gross and operation profit margins are much higher and more stable. For example, gross profit rose to 45.85%, while 7-Eleven stay around 30%. Mr.Diy also saw stronger net profits, ROA, and consistent ROE, unlike 7-Eleven, which fluctuations a lot. In short, Mr.Diy is clearly more profitable and stable.
I will present recommendations for 7-Eleven company. For the first one, liquidity ratios. 7-Eleven need to improve how it manages its cash and short-term assets. We suggest cutting down on unnecessary stocks, managing cash flow better, and working with suppliers to get better payment terms. This will help the company stay financially stable and avoid cash problems. Second, receivable and inventory management. In 2024, customers took longer to pay, and stock turnover slowed down. To fix this, 7-Eleven should tighten credit rules, send payment reminders, and give discounts for early payments. At the same time, it should avoid overstocking by using better demand forecasting and only ordering what is needed. Number 3. Capital structure ratio. 7-Eleven relies too much on debt. To reduce this risk, the company should pay off high-interest loans and switch to longer-term loans with low interest. They also should plan their financings better and avoid borrowing unless necessary. 4. Assets management efficiency ratio. To improve how assets are used, 7-Eleven should look at underperforming stores or assets and either fix, relocate, or sell them. Before spending on new items, the company should do a proper return on investment check. Also, using digital tools like online sales and delivery platforms can help them get more value from their existing asset. 5. Profitability ratios. Even though sales stay strong, profit dropped in 2024. To improve this, 7-Eleven should cut unnecessary costs, push higher margin products like their own brand items, and improve pricings. Keeping expenses low and sales high will help boost profit again.
My name is Ng Sing and I would like to present the recommendation for Mr.Diy to improve their company. Mr.Diy's short-term payment ability has improved, but it should avoid holding too much cash or inventory. The company can improve by managing cash and stock better, collecting payments faster, and investing extra funds wisely. Receivable and inventory are stable but still can improve. Stricter credit terms, early payment discount, and smart stock tools like just-in-time restocking can help. Mr.Diy's debt has decreased, but they still need balanced internal funds and loans, seek better loan terms, and avoid overissuing shares. Asset usage in Mr.Diy is efficient but not perfect. The company should fix or remove underused assets and consider renting and using more technology. Although the profit margins are strong, but net profit and return on equity declined in 2023. To improve, Mr.Diy can manage costs, sell high-margin items, expand online and into new markets, and reward investors.
For 7-Eleven, we recommend non-debt funding. Sales and leaseback unlocks capital fast, joint ventures reduce financial load, and equity fundings avoid risk interest payment. But for DIY, strong financials open multiple affordable financing options. Corporate bonds and can drive physical expansion, while internal fund and green loan support innovation and ESG goals.